Hey there, Prof. Aram here, and in this video we're going to see what is a bond and how firms and governments can use these financial instruments to raise money for their operations or for their investments. So let's get to this. First things first, let's see what is a bond. Since debt is a cheap source of financing compared to equity, many corporations choose to add long-term debt to their capital structure and enjoy the benefits of leverage and magnify their returns, and of course lower their taxes. So on the left-hand side of the balance sheet, you have the assets of the firm, and the right-hand side shows the sources of capital that firms use to pay for these assets. As I mentioned, since there is tax advantage to borrowing and leverage can magnify your returns, a lot of firms choose to add long-term debt to their capital structure. There are two main types of long-term liability or long-term debt. One of them is a bank loan, which is usually an amortized loan, and the other one is bonds, which most of the time is a interest only loan. So let's say your firm wants to borrow $10 billion for a mergers and acquisition, or for whatever reason that they want to borrow money. So they have two options: either borrow from the bank or issue bonds. For the first option, it's usually very unlikely to happen. A $10 billion loan is too risky for a single bank. They have too much exposure to one company. So usually they're not going to be able, the company is not going to be able to have a commercial loan for face value of $10 billion. But bonds in this case are going to be very attractive, are usually the way to go. And bonds are usually like a crowdfunding practice. It's like borrowing from many individual and institutional investors. So instead of borrowing from one entity, which is the bank, you're going to borrow from many investors, individual and institutional investors. It's like a crowdfunding practice. So, and the way to do this is usually you go to an investment bank and hire an investment bank to go through the issuance of these bonds, to underwrite these bond issuance. So let's look at an example of the bond. This is an old one that was issued in 1973 by Ford Motor Company. And usually these bonds give you information about the maturity date. The bond was issued in 1973, but the maturity date of the bond was January 15, 1990. And it also shows how much interest the company pays. We call this a coupon rate. And then it also specifies the par value of the bond, 5,000. Nowadays, par values are usually 1,000. And then each bond or each security actually has a CUSIP number. CUSIP is short for Committee on Uniform Securities and Identification Procedures. So every security that you see is traded in the US market has this CUSIP number. And of course, the name of the issuer. Nowadays, you don't see a certificate like this. Everything's electronic, but still, you're going to see the same type of features in today's bonds. Now, let's look at some of the features of a typical bond. As I mentioned before, a bond is an interest-only loan that pays the interest income every period plus the last interest income happens at the maturity of the bond, and then you receive the principal of the loan at the maturity as well. So the first thing that we will look at is the par value or the face value or the principal amount of the bond. So this is the principal amount to be repaid at the end of the term. So when you look at the bond contract, this principal amount is stated there and it's fixed. So in other words, every information that you see here on this bond is going to be fixed. So the principal amount doesn't change, it's going to be fixed. And then coupon rate also mentioned in the contract, and this is the stated interest on the bond, and it's also going to be fixed. This doesn't change through the life of the loan. So the coupon income or the dollar amount of coupon that you receive is the periodic income from the bond that equals the coupon rate, this one, times par value. So usually it's the percentage times 1,000. Maturity is the date at which the firm must repay the principal amount and the last coupon. And yield to maturity is the required rate of return on the bond. So this is the market required rate of return, and this is market driven, meaning that the rate, the yield to maturity that you see on the bond depends on the demand and supply for that particular bond on a particular day. So yield to maturity can change from day to day, but this coupon rate is fixed. So because yield to maturity changes by day, the value of the bond also changes by day because the value is dependent on this yield to maturity. This yield to maturity, in other words, is your discount rate for valuation of the bond. So when you look at the relationship here, what we use the coupon rate to calculate the income or the payment on the bond. After that, you're going to throw it away. We're not going to use it again because coupon rate is not your discount rate. We are not using coupon rate as IY in the financial calculator or rate in Excel. So the ones that we are going to use yield to maturity for these two inputs in our tools. So coupon rate is not your discount rate. We never use it as our IY or rate in financial calculator or Excel. In terms of the timeline of the cash flows for the bond is similar to an interest-only loan. So your present value or price is for today. Each period, right, we will see our payment to be coupon rate times future value or par value or face value. And then at maturity, so this is a bond that matures in 6 years, at maturity you're going to receive your last coupon plus the principal amount that you put up for this bond. Okay, I hope you find this video useful and thanks for watching.